Hello and welcome to Dynamic Wealth Management's update on the markets and ETF model review. I'm Adam Carlini. With me is Gary Luna and also Grant Haddon, the third member of our team. This is the October 13th, 2015 installment, our third review of where the markets are at and what's going on and what we're doing about it. Gary?
We've had 2 good weeks in the market, pretty strong weeks, so a lot of good information to get to you in the next few minutes. So let's go ahead and jump into things.
All right, real quickly, before we get into our analysis, we'll go over upcoming events. So we've got our investments for breakfast. We do that every Tuesday. So that next one is October 20th, then the 3rd and the 17th. That's held here at our office in our conference room. We have a light breakfast served. We welcome anyone who's not already a client. Please come out and visit us. Those who are clients, we love to have you come. Bring a friend with you and introduce them to what we're doing. If you'd like to get additional detail and get more questions answered, come on over to our investment seminars. We've got one that's on October 22nd at 9 a.m. at Sun City Festival, and another one October 27th at 5 p.m. at Sun City Grand. That's where you get a chance to meet with us, have your questions answered, and get a lot more detail on what we do and how we do it. So, our risk indicator, which had been over in the neutral zone, just barely, has now moved into bullish territory. Wow, what happened? Well, the FOMC meeting notes is what happened. They came out and basically said that the likelihood of an increase in interest rates in October has dropped down to about 7%. So not very likely. And the likelihood of an increase even this year, December would be the next time they could potentially increase rates on a normal schedule. That's dropped down to about 36%. So the likelihood of an increase this year has given people some excitement to get back in the market, that maybe things will stay status quo, maybe this thing can run up a bit further. And so that's what got things moving. We'll go ahead and have Gary go over where things look now and cover our model and what's going on in our next segment.
Okay, thanks Adam. Let's go ahead and get into the stock market. We will start off with the S&P 500. Remember, this is a 6-month chart, and every one of these marks, we call them candlesticks, are a day in time. So what you're seeing is the formation of a W. A lot of people talking about that. And the good news about that is the market dropped down to this level now twice and held. And so that was a good thing. When we came back down here again, that was a good bounce point for the market. And over the last 2 weeks, we've had a good, strong up move coming up here on this side. We've now surpassed this level of resistance. Hopefully it becomes a level of support underneath us, where we are at about 2,000 or 1999 on the S&P, and we also have a couple moving averages that hopefully that gives us some level of support to move off of as well. As we'll see in this chart, the move was just not in the S&P 500, but across all the major U.S. market averages, including the NASDAQ, small caps, and the Dow, which collected anywhere from 6% up to about 7.6% on the broad New York Stock Exchange. So that's a good amount of breadth in the markets that a lot of stocks participated on the upside over the last couple weeks. How about international markets? Well, international markets as well. In fact, they did even a little bit better than the U.S. markets. International developed countries did about 8.3%, and international emerging markets did about 12%, and even commodities, which mainly because of energy and gold actually participated on the upside as well, went up over the last couple weeks at about 3%. Also notice that on the other hand, U.S. Treasuries or bonds were down the last 2 weeks. So we can definitely see that over the last 2 weeks, this was a strong move towards risk, away from risk-off assets. And so what did that do to our model allocations? Well, as we talked about at the beginning, that pushed us up over the next key moving average into the bullish zone. Even though we're reluctant to do it, that is what price action is telling us to do. So obviously, if price action breaks down again, we will have no problem putting on the brakes and getting cautious again. For now, we hope this level holds and we can move off of it, but obviously price action will dictate and will be king for us going forward. So there you can see a reminder about our allocations across the different client risk tolerance profiles of growth, moderate, and conservative. If you have any questions on those, you can contact us directly. As always, remember that past performance is not a guarantee of future results, and individual results may vary. And obviously, this is not in any form or fashion a solicitation to buy or sell any particular investments. We are basically tracking and giving information that is useful to our clients and potential clients as to what we're seeing on the marketplace at a very high level. For more detailed information, please contact us directly, and we will be more than happy to sit down with you and talk about your specific situation. Again, a reminder on the events. We look forward to talking to you again in a couple weeks. Thank you very much.